Okay. Alright, so the next series of slides is really a recap on what we just covered, plus we're going to get into examples, simple examples, and then exercises I want you guys to do as a group together. Okay? So this chart summarizes for non-statutory awards, basically NSOs, or restricted stock. Do you get a future employer deduction? Yes. You get a future deduction whether it's an NSO or restricted stock. How do you determine the amount of the deduction? Well, for NSOs, it's the amount of the gain built into the stock when you get the stock. Right? People call that the intrinsic value. Or sometimes people refer to it as the spread element. Right? It's the spread between what you paid and the value of the stock that you got. For restricted stock, it's just whatever the value of the stock is. And then the last row, do you book a deferred tax benefit anticipating a future deduction? And the answer is yes for both NSOs as well as restricted stock. Okay, so it's very similar whether you're dealing with NSOs or restricted stock. The only difference is really economically how the company valued the stock awards, right? But otherwise they're the same, right? You anticipate a benefit, you get a deduction when there's a realization event. It's just a matter of how much. Actuaries come up with this number. You mean in terms of what the book expense is? No one asked the tax person what the number is. That's for sure. Yeah. They're not asking. Yeah. Timmy would be like 50 cents. Yes, Brian. Yep. Okay. All right. Case 1. Company A grants a non-qualified stock option. The stock is valued at $30. Okay. Let me make sure I got my facts right here. Strike price equals the market price on the date of grant of $40. Okay, so the $30 fair value, that is the value of the option. It's not the value of the underlying stock. It's the value of the option. So remember earlier we were saying, well, how much on would you pay for the right to get SanDisk shares at $33 anytime in the next 10 years? That value, that quality of being able to get that $33 price anytime in the next 10 years, that's $30 in this example. That's what it's worth. And the stock is worth $40. Okay? So the Black-Scholes value, or the fair value of the option, is 30. The fair value of the underlying stock is 40. So you have to think like a Wall Streeter here, right? You have to think like, what's the value of this option? Because anytime in the next 10 years, something can happen, right? So somebody thinks that $30 is the fair value of the ability to buy this stock at $40 anytime in that period. Okay. So the strike price is $40. The tax rate's 40%. And when this person exercises, the stock is worth $80. So what are the journal entries in 07 and 08? So in 07, which is the assumed year that you need to work in order to earn this option, Books is going to expense the $30. Right? I don't show the book entry here, but Books would be expensing $30. They would debit expense 30, credit APIC 30. And the tax folks are going to say, well, I need a deferred tax asset to anticipate the future deduction, so I'm going to set up a DTA and a provision benefit. Okay. And I think, Jesse, what you were asking earlier is, you don't show the add back. Right, I've like jumped right past the payable, right to deferreds, right? I'm done with step one. Because if I'm doing my step 1, 2, 3 provision here, right, and I'm trying to figure out my payable in year 1, the way I would calculate it is I would say that my PBT is how much? Jesse? 30. Income or loss? Right. I have a PBT of 30 loss, right? My stock comp expense. Do I have any perms? No. Do I have any temps? How much is my temp? 30. So my taxable income? 0. My current provision? 0. Right? So I jumped straight past a payable because I just kind of knew the answer was 0. And I said, well, I'm just going to book my deferred because I know that exists, right? Because that's what happens when I have a timing difference. And I'll book my provision benefit. That's what I'm doing there. When we do our in-class exercises in a little bit, I suspect you'll do them like this. Okay, you'll do your payable, then you'll set up your deferreds, and now your deferreds and you'll have perms and temps all related to the stock comp business, but you'll start with PBT and all that, just like Jesse was alluding to. Am I saying that the tax treatment of NSOs and RSUs is always the same? As a general rule, yes. Yeah. It could be different, like foreign or 162M or all those kinds of things, but in general, simple example, yes. Okay, we good with that? We good with our 2007 entry?
It's $30 because that's the value of the Black-Scholes value is $30.
$30 is what I expensed. And the way the rules work is they say take what you expensed and assume that will be your future deduction. We expense whatever we said was the fair value. So some Timmy out there said that that stock option was worth $30. How did he come up with that? I don't know. It's kind of black box. Right? There's some formula like Black-Scholes that you put in 6 inputs and out comes a number. The strike price is 40. That's today's stock price. The value of that option doesn't much have anything to do with today's stock price. It has everything to do with what might happen in the future. So the question is, how much is it worth to you to be able to buy stock at $40 a share in the future? Somebody's told me that's $30, right? If the stock barely moves, it's probably going to be like $4. Right? If the stock is, like Apple, it's going to be a lot. Strike price and the exercise price are the same thing. Yep. Strike price and exercise price mean the price at which you can buy the stock. It's $33 in Ann's case. Ann can take $33 out of her wallet and go get a share of stock anytime because she has that option. If the stock starts going up, that option starts to be really valuable to her. Right? And actually has a value today, she just doesn't personally believe it. And so the value today is what some finance person has calculated. Okay? Okay, so that's our 2007 entry. So now in year 2, the deduction is actually 40. Because I said that the value of the stock upon exercise was 80, right? There's an 80 fair value. This person paid $40 strike. So this 40, that's the spread. Okay? That's the gain that person realized, and that's the corporate deduction that the company gets. Right? So, the way this journal entry is set up, it's set up into 2 entries, but the way I would explain it is the first thing I would do is I would book my debit to taxes payable for the $40 deduction times my 40% rate. Second thing I would do is get rid of my deferred. In my balancing entry, because I have an excess deduction, my balancing entry goes to APIC, right? Because I have an excess. The provision entry is wash, because that's just my typical current deferred provision with any temp. Okay? So I have a deferred expense and a current benefit, but when you cut through that, you're really just saying, I'm reducing my payable, I'm eliminating my DTA, and my credit excess goes to APIC. Okay? There is no P&L event in year 2. Year 2 is just balance sheet. All right?
That deferred tax provision, what is that? How is that classified?
Well, deferred tax provision, I mean, that's a little confusing. That is expense.
Is that expense?
Yeah, I mean, this is P&L here, but this is P&L here, and they just offset. So that 12 credit, that 12 debit, that's just netting. It's relevant for your footnote disclosure, but for, I mean, this example is hard enough. So if we just said, well, the provision's a wash, let's worry about balance sheet. The point of the example is to say, I'm showing my receivable effect or my payable effect. I'm eliminating the deferred asset I set up last year, and that excess tax savings I got, that goes to APIC. Okay? See, man, you guys are totally less interested when I start talking about tax, man. We were like we were better when we were talking about On's money, huh?
No, I disagree. We're just so focused on what you're trying to say, and we're trying to assimilate it in our brains.
Okay.
Because the quietness is that we're...
More than the quiet, it's the expression.
Well, lost is, you know, okay.
Okay.
The blank faces and slack jaws.
This is key. Lena. First entry. First entry. In 2007, you said, you know what, I think when this option's exercised, I'm going to get a deduction. 2008, you're like, man, I got the deduction, right? That option's gone, right? I can't anticipate more deductions. The option is no more. So my deferred, it's coming off.
What's not up there is the $30 that basically he picked up as salary expense in the other side of the entry.
That's really a year 1 entry.
Yeah. But it's the same as.
Go ahead, Grant.
I think there might be some confusion that might be added to this from the fact that you have a spread of 40 and then you have a spread, right?
Oh,
Yeah, that's fair.
So what if it...
That's just me messing with you. That's right.
What was that?
Well,
No.
let's say it was 70 market price.
Well, if it was 70 market price, you would just reduce your payable by 12, because that would be a $30 deduction.
Right.
70 minus your exercise price of 40. And ironically, that would have been the DTA you set up, because that was the book expense. That never happens, but it could. Right? If the stock went to like 140, then your tax savings would be the $100 gain times the 40% rate, but you only have 12 of DTA to reverse. So your APIC would be huge. Right? That's what's happening at Amazon. Right? They're like, here's a share of stock 3 years ago when our stock was 120 bucks. Now it's 250 bucks. So that delta, that's all running through APIC. Okay. All right. Okay, so what's your rate rec in year 2? Michelle?
Well, before you were then, you last, or year 1, right? You were from
Well, I don't know about year 1, but we're doing year 2. So what's our year 2? What's our year 2 PBT? What's our provision in year 2, Rochelle? 0. Timmy's just making up numbers over there. Okay. So can you reconcile 0 to 0, Rochelle? Are there any adjustments? No, there's nothing. That is your rate rec. It's the world's simplest rate rec. Because in year 2, there is no book expense. We expensed it in year 1. There is no tax provision in year 2. We booked our provision in year 1. Year 2 is just balance sheet cleanup. Right? Right. Okay. Let's keep going because we're not making great time here. Case 2. Company A grants a non-qualified option. This option is the fair value of the option is $25. The strike price is again 40, tax rate is again 40, but this time when the person exercises the award or the option, the stock is only worth $50. Okay, so how much is the deduction? Linda? In year 2, what is the tax deduction to the company? Jenny, what's the tax deduction in year 2? 10, right? The stock is worth 50, and the person had to pay 40 to get the stock. So some, math whiz thought that option was worth 25 back when it was granted, but it turned out this person only realized the gain of 10. Right? Right.
Well, wait a second. Wait.
So somebody said that based on all the data they had when the stock option was granted, it was worth $25. But I mean, these things don't turn out to be true. It could be worth more or less. And this person, maybe they were an eager beaver and they were like, I need to just exercise when I got some money and I'm out, right? I'm not going to wait all 10 years to see what else happens. I might just pull the trigger right away. I'm like, I want my money now. So when the stock is worth 50, I pay 40. I sell the stock, I make $10, right? Food on the table. So that $10 gain, that's what goes in, the person's W-2, and that's the tax deduction for the company as well. Okay, so in year 1, in 2007, books expenses 25 because that's the value. So we anticipate a DTA of 10, right? 40% of 25. We just assume that whatever books expenses, we're going to get a DTA for. So this is the same thing as the last example. We just take.
Go back to the. I guess. Isn't the value to 25? Isn't the value to 25? But it's at the date of grant is 40. You would put the
fair value. The fair value
to 40, which is $15 to expense and to the other side.
Now the fair value of the option is what gets expensed. The stock price doesn't matter. It's the 25. That's the fair value of the option. Books expense is 25. We anticipate a deduction of 25. Okay. So now, when we get our deduction of 10, we're going to reduce our payable by 4. $10 deduction, 40% tax rate. We anticipated a benefit of 10, $25 times 40%. So we had a DTA of 10 that's got to go. Our balancing entry is a shortfall, right? Our DTA was bigger than our savings. Our shortfall is 6. And here the assumption is we have sufficient APIC pool. So we book the entry to APIC. Okay? We do step 1, we figure out the payable. We do step 2, we figure out what the deferred is. And then here our balancing entry is either APIC or provision, depending on whether it's excess, shortfall, and whether we have a pool. All right. Awesome. In-class exercise 1. So Anna would have sent out materials. They had 4 problems. Do the first problem, work in groups, and then we will get back together and go through it.
Our uses autobiography is worse.
All right. Speaking of biographies, I read Tyler Hamilton's book on doping and bicycle racing this weekend. That book just came out. I don't know if you guys saw like the big Lance Armstrong news this week.
Yeah.
And a lot of it was predicated on this Tyler Hamilton book because Tyler was on his team. And I was reading this. I read the whole book Saturday night, and oh my gosh, it was so pathetic. I mean, it would appear that nothing happens but doping, you know, and it's fascinating. Okay, in-class exercise 1. Okay, so we have income of $3.75 million. We've got a small perm for meals and entertainment, small temp for bad debt. I threw those in just so you can see how kind of the mechanics of a provision mix in with these stock comp assumptions, just so it looked a little real. But those are pretty easy, I think. So this year we have a new grant. So we gave somebody an option that was worth $165,000 when we expensed it. But nothing's happened to that option yet. We just granted it. Okay. Then there was a second option that somebody exercised this year, and we claimed a deduction for that option of $35,000. But in a prior year, we had expensed $50,000 related to it. Okay? So if you're getting the idea that you have to do this whole thing on like a grant by person basis, the answer is yes, that's how you do this. Right? It's very hard to accumulate things. So companies have big databases of, you know, every grant for every person, how they set up and reverse DTAs. It's very voluminous, very time consuming. Okay. We have an NOL. Our tax rate's 40%, and we are assuming that we have plenty of APIC pool. Okay. All right, so let's do our provision. Well, first of all, what, Michael, what did you get? What's the provision?
I got, what's the final number?
Total provision.
1,520,000.
Okay. Heidi, what did you get? What did we get? 1,320,000. Can you read? Sure, you read your own writing right? Okay. All right, let's go through it together then. Okay. So, let's do our current calculation first. So we have PBT of 3,750. We have a perm for meals and entertainment of 50. Bad debt reserve as an add back of 175. What are we going to do with that stock comp expense of 165?
Add back.
We're going to add that back. We're going to call that SBC 1. Okay, SBC 2, what are we going to do with that in our current calculation? Deduct, Timmy, how much are we going to deduct? 35. Okay. Our taxable income is what? 4105? Michael, what did you get? 4105. Can't go wrong with Mike. Okay. We have an NOL 500. So that means taxable income after NOL is 3605. Our tax rate is 40%. So, Patty, what is that?
Well, I did my 40% and then less my, well, which I shouldn't have done, but anyway, I don't know if it comes out the same. 1.142.
1.142. I'm going to go with no. Mike, what did you get on that? 1.4? 1442. That sounds more like what we're going for here. Okay, so our current provision is 1442, right? Okay, our deferred provision. So at the beginning of the year, we have, let's say, okay, I'm just going to make a little line here. We've got SBC 1, SBC 2, bad debt reserve, NOL. Okay, so at the beginning of the year, we had one deferred for stock-based comp 2 of 50, right? So then the second deferred we have is an NOL, which is 500. So we have gross deferred assets of 550, 40%. So that difference is that's 220, right? So at the end of the year, our stock-based 2 deferred goes away because our option was exercised. Our stock-based 1 deferred goes up by 165. Our bad debt reserve goes up by 175. And our NOL goes away. So at the end of the year, we have 136 of deferreds. Right? So that's 330, 340 minus 160, 210. 210, 40%, 84. Okay? So our deferred's changed by 84. You'll get the solution, so follow me as opposed to writing. Okay? What's that? The video's going to come out. Yeah, I don't know how to move the thing, so I'm just trying to write within the little block things. Yeah, that's what I thought. Okay, so normally that change in deferreds is going to go to deferred provision, right? But we know that within that change in deferreds, we have that stock-based comp 2 item where some of the deferreds is actually moving against APIC. Right? So if I was creating a journal entry off of this, I know that my credit balance or credit entry is going to be to DTA of 84. My deferred to move by 84. I know that within that 84, part of this stock-based comp item right here, it was moving not through an offset to the current, right? Because I have this 50 movement here, but there's only a 35 in the current. So that 15 shortfall, that's me writing off 15 of deferreds back to APIC. So I'm going to debit APIC 6, right? 15, which is my shortfall, times 40%. And I'm going to debit, I'm going to debit my deferred provision for the difference, 78. Right? So my current provision entry, just so I got both of these down here. So I've got deferred, or current provision rather, current provision of 1442 and credit payable 1442, and then I got my deferred entry to the right of that. Okay, so my total expense ought to be this 1442 and this 78, which should be 1520. And some of you that got 1526, it's because you were missing this. You were moving the entire deferred change through provision instead of taking that shortfall to APIC. If you got a number different than 1520 or 26, I'm not sure what you did, but 1520 is the right answer. And if we did our rate rec, we would expect our PBT of 3750 at 40% would be 31500, and we get to 1520. Our only perm is M&E of 50 times 40% is 20. That's like the world's second easiest rate rack after that 0001. Right? So all that stock comp madness, it had no bearing on our tax rate. Right? It was very confusing in terms of setting up deferreds, reversing deferreds, hitting APIC, getting my payable right. It's very confusing on the balance sheet. But in that example, there was no rate volatility. There wasn't any kind of surprise that it changes the income statement. Okay?
So prior to this problem, I was under the impression that you take the expense for books for the year. That's what you use for the tax deduction. So that's not how it works.
Well, prior to this problem, Timmy was saying he was under the impression that he would take the book expense and assume that that was going to be the tax deduction. Well, that's what we've done here. We've added back the book expense, and we've said that we are going to expect it to be the future tax deduction. What I threw in the example was not only the setup of a deferred, but also separately the reversal of another deferred. So that other deferred, right, this guy, I can only put through my payable what actually happens, but I had to reverse from my deferred whatever I expected would happen, even if it's different. Right? So as you can imagine, for companies, there's setup and reversals happening all the time, like every second of the day, right? So you won't see in a provision, this granularity of an example, but you'll see reports that'll be gross setups, gross reversals, gross shortfalls, gross excesses, and you'll just, from a conceptual framework, know how to throw those into the model within their individual components. Okay? I mean, we're not going to do a provision here where we throw more at you than this, but you need to know that there's lots of moving parts.
Can you explain again how you got the 6 for APIC?
The 6 for APIC, was me saying we had a DTA of 50 times 40%. We had a DTA of 20. That 20 needed to go away. We're going to credit DTA for that 20 that we had set up in the prior year. But the amount of tax that we saved on account of that option was only 35 times 40%. So 35 times 40% is going to be 14. So that means we have a shortfall that because we have APIC pool, we're going to balance with an APIC 6. So that movement in deferreds isn't fully deferred provision, it's APIC to an extent. So a lot of times what you'll see companies do from a presentation perspective, they might show DTAs at the beginning of the year. Then they'll show their payable activity. So you might put in the 50 here, the 35 reversal that showed up in your payable column. Then they'll have a shortfall column of 15. And then they'll have an end of the year column, which will, in this case, will be 0. And they'll know that the other side of this entry is essentially payable, and the other side of that entry is essentially APIC. So if you think of every column in your deferred roll forward as creating a journal entry, some people format it like that. Okay, so that's our problem 1. We have an hour of class and 3 more problems to go. It's no problem. Oh, yeah. Okay, so part 2. Assume the same facts except for that only 5,000 of APIC pool exists. So now, if you only had 5,000 of APIC pool, you can't debit APIC 6. You can only debit APIC 5. So that excess 1, that's going to go to provision. Right? So your provision is now 1521 instead of 1520. And in your rate rec, you have a 1 increase in provision.
So, in a sense, you just created a permanent difference?
You created a perm item that increased your effective tax rate.
Pool is cleaned out.
Your pool's done, yeah. Okay, so I'm hoping you can get class. I want to go on to example 2, so I'm hoping you can figure out part 3 on your own. Okay, so back to the slides. Okay, so what we just covered in the simple slide examples and then also in that in-class exercise was non-qualified options and restricted stock. Right? And with those, we anticipated deferred, we get a deduction. Okay, now we're going to talk about ISOs and ESPPs. Okay, so same sort of little matrix here that summarizes things. So if we have an ISO or an ESPP, are we assured of a future employer deduction? No. Maybe, but we're not assured of it. How is the deduction determined? Well, if you don't get a deduction, you don't get a deduction. Do you recognize a DTA? No. So basically, if books expense is an ISO, you're not going to do anything for tax. You're going to be like, yeah, well, I don't know if anything will come of that. So I'm just going to treat it as if it's a non-deductible book expense. Okay. If there's a disqualifying disposition in the future and you get a deduction, well, then that's an issue you deal with later, but you don't anticipate it. Okay. Okay, so we're going to go through 2 cases just like we went through the 2 cases for the non-qualified awards. Okay, so case 3, Company A grants an ISO. The value of the option is 30. These are the same exact facts as the NSO, but now it's an ISO. The value of the option, not the value of the stock, the value of the option is 30. So books is going to expense 30. The strike price of the stock is 40, the tax rate is 40, the spread amount ultimately is also 40, right? Just to use 40 as many times as possible. Okay, but those are 3 different 40s. Okay. In 07, books is going to record an entry. Books is going to record an entry which is debit expense 30, credit APIC 30. We can't anticipate that that book expense of 30 is going to give rise to a tax deduction, so we book no journal entry. And the fact that there's no journal entry implicitly creates a perm, because we're going to add that back and not set up a DTA. It's going to look like we're adding back like meals and entertainment or fines or stuff like that. It's going to be a book expense that's permanently non-deductible. Okay? So when I say there's no journal entry, I just mean that if books recorded this entry in front of us, and the tax guys needed to show up and book an accompanying journal entry, we would do nothing. We have no effect to the payable. Our payable 0. We can't set up a deferred, and therefore there's no provision effect. There's nothing to do. But when you look at the rate rack, you're going to see 30 of expense and 0 provision. So that's not good. It's not good when you have an expense and no corresponding provision benefit. That's a rate increase, right? Okay, in 08, the person exercises their option, and there's a disqualifying disposition because they're like, I will take the money, right? I'm not holding on to this stock. So the the deduction that the company picks up is 40, right? It's the $80 value of the stock minus the $40 that the person paid. The total deduction that the company gets is 40. So now this is a little confusing. If we have a $40 deduction, we know we're going to save $16 of tax. We got to debit our payable 16. Our excess, we thought that the book expense was 30. So at most, we thought we were going to get a $30 deduction, but we actually got a $40 deduction. So the deduction in excess of book expense, the excess, is 10. That 10 increases APIC. So I'm going to credit APIC 4. And my provision, my good perm, is 12. Okay? That good perm can never be more than the bad perm I booked in year 1. So the bad perm I had in year 1 was the $30 book expense I treated as non-deductible. That effectively increased my provision by 12 in year 1. Right? $30 times 40%. So if you were doing a rate rec for year 1, you would see a 12 bad guy in the rate rec because of this item. In year 2, I can take a 12 good guy. I can't take any more than 12, but I could take up to a 12 good guy, and then the excess goes to APIC.
Did you increase your APIC at the very portion of the process?
Through this whole process, I've recorded a provision benefit. I recorded a provision benefit of 12. Because remember, I didn't book a tax entry at all in year 1. I booked a provision benefit of 12 and an APIC entry of 4. Which is exactly how the NSO worked. If you remember back to the NSO. The huge difference is that with the NSO, this entry was booked in year 1. Not the current provision, but you booked a provision benefit in year 1 because you could anticipate this. With ISOs, you have to wait until it actually happens. Right? So you could be giving ISOs away for 5 years in a row and not a single person would exercise. And it would be like bad perm, bad perm, bad perm every year. And then all of a sudden, if everyone's like, okay, it's like flash mob exercise, right? Everyone exercises at the same time, you'd get a giant good perm all at once. That's how this would work. Okay? So you have a bad perm on the front end because you can't anticipate a deduction. It's like a permanent non-deductible expense. And then later down the road, it's like, oh, that wasn't non-deductible after all, so it's like a permanent good guy. But any excess goes to APIC.
It sounds like a temporary, but it isn't. It's permanent.
It's like a temporary item in this example only because you have the benefit of hindsight. In year 1, it doesn't look like a temp. But then in year 2, you're like, nah, I got to catch it up. Right? Okay, case 4. Same facts as the case 2 with the NSO. The fair value of the stock is 25. Now our stock when we exercise is 50, so there's only a $10 deduction. Same exact facts, except it's an ISO instead of an NSO. Okay? So in year one, bad perm, right? We have 25 of book expense, but there's no corresponding tax entry, right? The book guys, the book guys are going to debit expense 25, credit APIC 25, but the tax guys are going to do nothing. Because we're going to say this is an ISO, I'm not assured of a deduction, that expense is non-deductible, I'm doing nothing from a tax entry perspective. But in 2008, I'm going to say, oh, well, I get a tax deduction. I got a deduction of 10, which reduces my payable by 4. And here, remember I said you get a good guy. Your good guy is the lesser of your total benefit or your prior bad guy. Okay? So it's the lesser of your prior bad perm or the total benefit. So our prior bad perm was 10, right? It was 25 times 40%. That was our bad perm from year one. So in this example, we're going to look at the lesser of our prior bad perm, which was 10, or our total benefit, total tax savings of 4. That goes to your provision. So here, if you're processing this at all, you're going to say, this is like a shortfall. Seems like a shortfall, right? I expected 10, but I only got 4. So do I do anything with that 6 like I do with the NSOs in terms of jamming that back to APIC? And the answer is, Lady Min? 50-50. You should have said, shake your head and no. The concept of a shortfall only exists because you have DTAs that are bigger than your actual deduction. That DTA, that excess asset you have that you need to write off, that is a shortfall. You don't have that with ISOs because you never set up a DTA. There was never an excess asset you had to get rid of. All that happens with ISOs is you take all the bad news on the front end because you're like, I don't think anything is going to happen, right? Nothing could be worse than that. So it's kind of like you've said, I'm in the worst case scenario in year one. And in year two, when something good happens, well, it can only be good news. And basically you book provision benefit up to your year one bad guy, and any excess, APIC.
Say that last thing you said.
Any excess, any tax savings over what the book expense would have implied, that benefit goes to APIC.
When we talk about the APIC pool, it's like a separate piece of APIC that just...
The APIC pool is an offline tracking of a component of APIC, yes.
You can't just take, oh, all this APIC in there, because it's constantly growing.
APIC is made up of many things, and we care about the little subset of APIC, which is the APIC entries we're booking. If some controller books another APIC entry having nothing to do with this, that is of no concern to us. So the APIC pool is not the APIC balance.
We can't use that?
So when it comes to, you also said you track everything on a lot basis, in a sense, like grant basis.
Right. You could exercise one share at a time, and the report that Janie will get when she's doing the provision will show you exercising one block at a time.
But you're able to take it from like, I have some, historically had some ISOs and I got some MQs and stuff like that. These are all items that historically have gone into that APIC pool. And
Yes,
it doesn't matter lot or who
there's
has
big
what.
software that captures all this, yeah. Yeah. Okay. That's case 4. Okay, so I'm kind of feeling like you're getting it. So I think what I'm going to do is cover the rest of the slides, and then I'm going to have you do problems 2, 3, and 4 for homework, and we'll go through them in the first part of class next week. Okay? We good with that? If you guys are like violently opposed and you're like, no, these problems are way too hard and I'm super frustrated, we'll go through problem 2 together. But my vote is to keep rolling with the material.
Let's go to the material.
Okay? Okay. Your APIC pool, like we were just talking about, is that cumulative amount of credits to APIC you book because of the excesses. You'll see here in a second, I use this term realized on purpose, and I'll explain what that means in a second, but keep that in mind. So you do this on an individual award basis, all right? So when you see these reports that a company will print out, you won't see like an aggregate amount of deductions and DTAs reversing. You'll see gross. Because let's say that there's, let me just use an example. Let's say that there's SBC 1 and SBC 2. Oops, I'm going to have to have one of you guys teach me how to turn that off. So let's say that the book expense and the tax deduction, let's say that it was 10 and 10, and one of them was 12 and 9. This one has a 2 excess, and this one has a 1 shortfall. Okay? So this will cause you to credit APIC, and this will cause you to debit APIC, right? Assuming these are NSOs. Both of these, this will increase your APIC pool to 2, right? This will cause your APIC pool to go up, and the 1 will cause your APIC pool to go down. Where this gets exciting is in that cash flow statement. Remember that section one of you guys called out about the financing section? The only number that goes into that table in this example is this. It's the gross excesses. So it's not the net, it's the gross. So if an investor was wondering, I wonder how much that cash flow is really the effect of gross excess benefits, then it's the 2. Again, I have no idea what they do with that information, but that's what ultimately makes its way into the financial statements. Okay? So the APIC pool can never be negative. Once you've used up all your APIC pool and you have excess deferred assets you need to write off, you have shortfalls, you write those off to the P&L. Right? APIC pool does not go negative. To me, there's 2 kinds of companies. There's companies that have giant APIC pools that are so big they don't even know how big it is. And then there's companies that have like no APIC pool. There's very few companies kind of in between. And if you don't have an APIC pool, your life is tough, unless you have a valuation allowance. Because if you don't have an APIC pool and you have write-offs of shortfalls, it's going to be hitting your provision. It's going to be ugly, right? But if you have a valuation allowance, it's kind of like you don't have it deferred in the first place, right? So if you were a company that, let's go back. If you were like these guys, and you set up a DTA of 12, but you're like, you know what, I got a full valuation allowance, I'm not booking DTA's net, it's kind of like you don't have a deferred. So if you have a shortfall on a deferred you basically said wasn't there, it's kind of like no harm, no foul. Right? So there's no APIC entry because there's no net deferred to get rid of. The valuation allowance basically says that deferred didn't even really exist.
It's not something you need to keep track of for some things down the road.
No. Valuation allowances are bliss for this situation, yeah. But if you don't have a valuation allowance and you don't have an APIC pool, like that's the danger zone. Right? Do you know if you have an APIC pool on?
In the Amazon deal, I noticed the breakback, it's like a hidden from the stock, some excess stock compensation tax. That one of the things that they don't have the APIC pool.
No. We'll come back to Amazon in a second. So, you said you have a big APIC pool? You're trying to determine.
It's like someone saying.
See, it's so big they don't know. That's what I just see. What I said was right.
They probably don't know their bank accounts reconciled either.
Jamie, you're gonna win the Red Bull. Do you know if you have an APIC pool?
I'm not, quite honestly.
I'm guessing you do.
Yes.
Yeah. See, like Linda, I mean, I know, Linda, you weren't doing provision stuff at Oracle, but Oracle would have a gigantic APIC pool, right? Humongous, right? Just think of a big number and just think a lot bigger than that. Yeah. Okay. All right, so that's how the APIC pool works. When FAS 123R first came out, man, there was so much energy poured into figuring out what your APIC pool is. Very few companies spend time on it, so like what An was saying, that's kind of unusual. No, I mean, no, it can make sense, but it's unusual because usually you fall into one of the two camps. Okay, so this is the last concept. I want to cover this, and then I want to go back to the Amazon 10K, and then we'll wrap up for tonight. Okay, so this situation, realization of excess benefits. So one of you guys, when you were talking about the Amazon 10K, you asked about this, and I kind of sidestepped it for the moment. And there were a bunch of footnotes under their deferred asset table. And those footnotes said things like, I have an NOL, but I'm not going to put it in my table. Right? So normally you'd say, well, what are you talking about? If you have an NOL, that's a future tax benefit. That sounds like a deferred, stick it in your table. Right? But in those footnotes they said, we're not going to do that. And the reason that they said that is because those NOLs are made up of stock benefits. Okay? And what this rule says, this rule called Footnote 82, so people will often refer to this as just Footnote 82, as if you know what that means. Okay? So Footnote 82 was Footnote 82 of FAS 123R, and it basically said that you don't book the effect of stock deductions that are excess amounts unless they reduce your cash taxes. So if you're Amazon and you have deductions that are so big that they not only save all your taxes, but they actually create an NOL, the rule would basically say, well, that NOL didn't save you cash taxes yet, so don't book it. Right? Because if you had that situation, normally you would say, well, I have an NOL, so I will debit DTA for my NOL, some number, and I would credit APIC because I would say that NOL is on account of the fact that I have these excess stock deductions. Footnote 82 says don't do that. Okay? So what happens is in a subsequent year, instead of doing this, right, you're not going to do that. In a subsequent year, if you're profitable and you would otherwise pay tax, but you actually don't pay tax because of these NOLs, you will reduce the payable that you would otherwise have because of those profits, and you would credit APIC then. Okay? So when Amazon said in that beginning that One of you guys said in the beginning of their footnote that they had that big provision, but they weren't paying cash tax. This is why. This is what they're doing. They're saying, I have NOLs. I don't need to pay cash tax. But I expense a provision, and then I offset it with that second entry. They're like, I don't owe cash tax. I have these NOLs that previously weren't realized, but I'm realizing them now. So that's super confusing. Right? I mean, you're basically saying, because when you read a company's financial statements, I mean, NetApp has this, I know it. You're basically saying, I have this NOL, but I'm going to only tell it to you in words, in the paragraph. I'm not going to put it in the table. It's not good enough for the table. But then when I use that NOL, out of nowhere, like, springs this great tax savings thing. Right? You would have thought I would have paid cash tax because I'm profitable, I have a provision, I must owe tax, and then you're like, but no, right? I have this thing I have not been really telling you about. It springs into action and like saves the day. It's like the Superman of tax, right? And the credit for that, you know, you debit payable to save the tax, and the credit goes to APIC.
Yeah.
It's wild.
I'm going to credit my equity.
You're going to credit equity because you're saying, I have an excess benefit. It's the same as the prior examples, but now, when I realize that excess benefit is a question of when I would have otherwise paid tax, right? In all the examples so far, we've just assumed that this company's profitable, and it uses those stock option deductions. So when you looked at, I mean, if you looked at like Yahoo's financial statements back in, I want to say 07 or so, they had billions of NOLs. None of them were in the deferred table. And actually, they were recording FIN 48 reserves for exposures and setting up liabilities. So they would show a liability on their balance sheet, and then in the words to the financials, they're like, don't worry, we have like billions of NOLs. Right? But it wouldn't show up in the financial statements. All you'd see in the balance sheet is a liability. You wouldn't see an offsetting giant asset. You'd have to piece all the words together, and I mean, there's like 4 people that understood it, right? And I was one of them. So it's very confusing.
Well, I guess it's like we have $8 billion of like non-cash NOLs.
Yeah, they're unrealized, not good enough for prime time NOLs for some reason. Yeah. How would you keep track of this? I make a career out of exactly that same question. Yeah, it's very confusing. Okay, and so that is a perfect segue. I should give you, like, you can earn the Red Bull for that one, because that's a segue into the next slide. There's 2 ways you can do it. These are the 2 ways. Oops. This little pen has a button on it, and I hit that button and funny things happen. There's 2 ways you can do it. You have to... Good grief. This thing's possessed. Okay, you can choose the FAS 109 ordering or the tax law ordering. Okay? And I'm going to explain how both of those work. And then Janie and Rochelle and An can go figure out which approach they use. Okay? So I'm going to explain it by way of an example, because if I said the words, I just can't imagine anyone will understand it. Okay? So our example, so we have a grant with $100 of fair value. Hey, I'm going to pause and save the video again. Okay? Oops.